Today, folks, welcome to the Tale of Three Investors, baby. We're talking about Steve Eisman, the guy from The Big Short, a legend that is now a speculative investor into the idea of story stocks. We're going to talk about Meet Kevin taking the exact opposite approach, basically shorting the market, scared as hell, running like a squirrel without a nut, looking for those views, baby. And finally, myself. I sold some of my interest rate recovery plays because I can admit that I was wrong about something, but not the interest rate recovery plays you might be thinking about, because I didn't sell my triple leverage ETF yet. But let's get into this first and foremost, folks. We're talking about what Steve Eisman said. If you're on a path to financial independence to perhaps one day or retire early, go smash that subscribe, join me on that journey, and that like while you're down there.
Like I said, good times is story time.
Yeah, story time, baby.
You know, where there are good stories, there are those big two, there's some others, you know, and an area where I think, for example, there isn't a great story is just in traditional banks. You know, nothing against traditional banks. They're all well capitalized. They're fine. They're safe. But can you construct a story that tells you that you really want to own banks? The only story that you could construct would be that Trump wins and the regulatory environment changes.
Come on, dude. Come on. They were such value plays. They're like utilities. There's certain sectors of the market that aren't going to be that explosive, but when they go on sale, you buy them. They're just good buying opportunities, right? Now, I get Steve Eisman. He's trying to outperform. He thinks we're in a bullish market. Clearly, the interest rate sensitivity doesn't affect him at all. He doesn't think we're going into a recession or a depression. So he's buying things like NVIDIA, story stocks. But don't shit on the banks. You've been shitting on the banks forever. This is where my heart's been, baby. I mean, JP Morgan's up 22% this year. Bank of America's up almost 19%. On the Canadian side of the border, man, if you locked in those crazy record high yields these things were paying out, you're up 23% on Royal Bank. Bank of Nova Scotia, baby, like Pokemon cards, you're collecting them all, you're up 15% here, another 30% in Canadian Imperial Bank. And the whole time, if you bought those bottoms, baby, you could have locked in a 7% yield, which would have given you your full rate of return. And now everything is the cherry on top of the cake. Don't get me wrong. I'm just, I collect these within my VDY ETF. I'm still buying it. It's the reason VDY is outperforming now this year. It's doing very, very well. But yeah, Steve Eisman is still a brilliant investor, but it's really neat to see the conflicting, discussions when it comes to Meet Kevin, because Meet Kevin is now the exact opposite of Steve Eisman. Forget story stocks. It's all about shorting the markets, baby. It's about a squirrel without a nut, I think, chasing those views, trying to drive in numbers, even though it's not going to help those viewers at all. And I think people are continually having this realization about Meet Kevin, because he obviously tweeted, sell stocks, take a vacation until early November. Why did he say that? Well, probably because he thinks past performance equals future returns. For the last several years, if we've followed this channel, we've talked about how the S&P 500 always seems to find, it sells down into September, finds a bottom in October, then rallies back into September. But we broke that trend this year. For the first time, it looked like we were starting to see it happen. And then boom, we went back to all-time highs on the interest rate cuts. So Meet Kevin, is really bearish about the economy, and even says, hey, if you've invested in things like my house hack, it's probably not going to do well if we go into a recession, which I think we're going into. So you gave me all this money on the backdrop of waiting for some growth to find out that there's not going to be any growth from the horse's mouth himself. But then you could invest your money into his ETF, his pricing power ETF, where he's promised, I'm going to buy stocks that have pricing power in tough market conditions so we can always outperform, baby. And we've been trailing the S&P since pretty much the historical existence of this ETF, but he was buying great companies nonetheless. I thought he was buying things like Apple. If you believe in Tesla, he's got Tesla in there. He's buying a lot of the semiconductors, right? Like things that you think would continue to do well and, actually are doing pretty well right now. What does he own? None of that stuff anymore. If I held this as a passive ETF that I wanted to hold long term and I believe in Meet Kevin stocks, well, guess what I own today? If I went to sleep for a bit, I came back. Now I own United States treasuries, mortgage companies. I own gold. I'm shorting Bitcoin. And yeah, I got some McDonald's too. It kind of reminds me of the Joker, right? That quote from The Dark Knight where he's like, I wouldn't want to, I'm like a dog chasing a car. I wouldn't know what to do if I actually caught one. What do I do if I catch a car? Because that's how Meet Kevin works. The squirrel without a nut. You're the one that you're the nut. You're the nut for his squirrel. He's just collecting you as viewers because he can capitalize on it. But his decision making is that of a psychopath, of an insane person that doesn't understand historical math. The math is you make more money being long-term in the market. The math is if you try and day trade and play, recessions and ups and downs, that if you miss just the 10 best days over the last 30 years, you've missed out on half the gains. We know this stuff. This is common sense today. And Meet Kevin's going to be one of those guys that's going to prove it time and time and time again, that he just he's not showing historical performance, but now that we have his pricing power ETF, we get a direct look into his mind, his insanity, and I think it's going to start to really lag your market performance, because you can't be buying, what the fuck, buying mortgage companies, gold you can't even trade and make a lot of money. Like, if you bought the bottom of gold this year and you rallied it up, or basically the February of last year, you made 30%. Whoop-de-doo, the market's almost up that much as it is for the most part. Like, it's kind of nuts. I mean, you go back 15 years ago and gold's not up a lot. Like, you can't even trade this to make real. Why are you owning this? It's not a productive asset. Eventually you're gonna have to sell it and profit take. Why are you shorting Bitcoin, where you will infinitely lose money and you'll have to get margin calls? Like, what? Why? This is the dumbest thing I've ever seen in my life. Like, I would never touch the most volatile asset and then short it. That's worked well for people. Like, I am not a big believer in Tesla at this valuation. I've lost a lot of respect for Elon Musk, but I get, if you believe in Tesla's story, you buy the tops, you buy the bottoms, you hold it long term. That's not me right now, but that could be you. Palantir, same thing. It's a story, right? You believe the story. Yeah, it's expensive. You buy the tops, you buy the bottoms, you ride it for 10 or 20 years. If you were a true believer in the company, you want to hold it long term. Heck, like, look at Nvidia. Even Nvidia is looking more favorably valued today than it has any time in its history. So it's just fascinating watching the clash of these variety of investors and just seeing where they're placing their bets to try and outperform, which kind of leads to discussion, what am I buying? Well, I'm glad my fiance still holds Meta, because it hit an all-time high this week. Our tech stocks have been doing exceptionally well. The S&P hit an all-time high this week, with one of the things that I got absolutely wrong about the current interest rate cut, recovery play. I really thought that as soon as they started cutting interest rates, we'd continue to start seeing rallies in the lower half, the dividend-oriented stocks, but it's not exactly what happened here. Out of nowhere, we saw this massive pop this week, basically from a broad variety of stocks that I wouldn't even say are all interest rate sensitive. Obviously, I think for the most part, every stock is interest rate sensitive, because it just affects how easy it is for people to spend money on the products. But you had a handful of tech stocks doing well, financials, even oil stocks, like such a mix. It was a mixed bag of performance this week, which I just found so peculiar. It's just as much as it was in the Canadian markets. Some oil stocks doing well, some not so well, some banks doing well, some not so well. It's just such an odd mix. But at the end of this mixful bag of stocks, we still ended up at all-time highs. VDY crushed it. I mean, we're up 12.69% now in this 1 year to date, right? The S&P's crushing it. So what did I sell? Why am I selling my interest rate recovery plays? Well, I'm not selling them like rushing out of these things. And I actually haven't sold DRN at all yet, even though this was like a massive run up. It hit $14 and then immediately sold off and has been down all this week. XLU was following the same suit. It's like people, made that bet that I made, where they started buying into the interest rate news. As soon as the cut happened, all right, let's take profit now, right? That seems to be what happened. XLU started doing the exact same thing that DRN did, this utility ETF, but then it exploded. So why was there a variance in XLU versus, DRN? Well, DRN, guys, I think was a pure recovery play. It was just one of these things where I'm not done with it by any means. I think this is what happened in the Canadian markets. You get some profit taking, but it should still be a long-term bull trend. So we'll see. We'll play this one slow. But the one I took profit on was XLU, because the reason it popped off so damn hard, and I'm over 10% on it in a pretty short period of time, is because 3 Mile Island, the nuclear power plant, that the top three holdings, being Constellation Energy, one of the top three, in XLU, just popped. It's up 30% just in the last week on that news that Microsoft energy demand is ticking up for cloud computing. All this stuff is going to continue to drive the energy sector. But again, this is speculative. It's not going to materialize anytime soon. And I'm not betting against XLU long run. I think long run it's going to be a great performer, but why not take profit? I crushed it on this. Typically what happens is when this thing blows up like it does, it tends to flatline for a bit or even trend down. I don't know if that's going to be the case here. And I'm still a long-term believer in utilities. I mean, who could not be, obviously, but I'm just redirecting that money into where the real performance seems to be, which is the S&P 500. I'm just took some profit, put it in the S&P when it pulled back today. I actually did a really good trade on it because I sold it when it popped off pretty heavy and flipped it into the S&P when it was down. And I'm just going to probably continue to do that because these are shorter term plays for me. My end all be all solution to investing for the most part is the S&P 500, VDY, and SHD. Those are where all my money ends up flooding to from the profits that we take on Tesla and these stocks. But at the end of it, I'm still trading. I got some small caps. We'll talk about that next week as well. But this is kind of where I sit Just fascinating turn of events, something that I don't think many people could have predicted with the interest rate cut cycle. It's the tale of three stories here. My story trying to compete against the broader market performance, that of Steve Eisman's and me, Kevin, and man, do we all have a variety of opinions because I'm a long-term cost average investor. Steve Eisman's more directed toward tech companies, which I am too for the long part. I mean, it's easy to get it through the S&P though. And then you got me, Kevin, who's fucking bananas. But I'd love to know what you think in that comment section below.